Hello and welcome to AI Market News by LM. Before we jump in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Okay, let's dive right in. This one phrase, it just perfectly captures the mood in the markets on Friday. It was a sea of red, a classic risk-off day where investors were just selling first and asking questions later. But what exactly caused these cracks in the credit space to suddenly appear? Well, that's what we're going to break down.
So the spark for this global sell-off actually came from a very specific place, the US banking sector. And it was a pretty stark reminder that a problem in just one corner of the financial world can, quickly shake the entire system.
And that tremor originated right here with US regional banks. Now, these are the banks that lend to small and medium-sized businesses, basically the real economy. So when they get a cold, the entire market starts to worry about getting the flu. The trigger for all of this was surprisingly specific. It all started with Zions Bank announcing a $50 million loan write-down. Okay. Then pretty soon after, Western Alliance revealed they had loaned money to the same borrower. The issue, it turns out, was tied to loan fraud involving collateral from a commercial real estate fund. This immediately sparked that terrifying question for investors. If it happened to these two banks, who else is exposed? And that right there is the core of contagion risk, the fear that one problem will spread to many.
And this number, wow, this shows the immediate market reaction. The S&P Regional Banks Index just plummeted 6.3% in a single day. This wasn't some minor dip, this was genuine panic selling. Investors were just dumping shares, worried this was only the tip of the iceberg.
Let's move to our next section and see how this fear, which started in just one part of the US banking sector, pretty much went global, triggering a massive flight to safety.
This table gives us a great bird's-eye view of how that fear spread across all the different asset classes. As we'd expect in a risk-off environment, global equities and crude oil sold off, no surprise there. At the same time, money just rushed into traditional safe havens like government bonds and gold, pushing their prices way up. But the really interesting move was in the US dollar, which actually went down. And that's because these credit fears led to bets that the Federal Reserve would be forced to cut interest rates more aggressively to support the economy, and the prospect of lower rates, well, that typically weakens a currency.
And the pain in equities was widespread. S&P and NASDAQ futures in the US were pointing sharply lower, and that selling pressure carried right over into Europe, with the FTSE 100 in London taking a pretty significant hit as well. This wasn't just an American story anymore. Over in the currency markets, the dollar's weakness was the big story, with the euro pushing all the way up to 1.17. But the other key move was in the Japanese yen. In times of global turmoil, the yen often acts as a safe haven, and investors were just piling in, pushing the USD/JPY pair lower.
Now let's look under the hood for a second at how traders were positioned. This represents the Oanda order book for the US dollar versus the Japanese yen. An order book basically shows us where traders have placed their buy and sell orders. So these clusters of sell orders above the current price, they act as a kind of resistance level, like a ceiling that can be really hard for the price to break through. And on the other side, the clusters of buy orders below act as a floor or a support level. It's almost like a real-time map of the market's battle lines.
So all that money flowing out of stocks had to go somewhere, right? Well, gold had an absolutely spectacular run, on track for its best week since the 2008 financial crisis. At the same time, investors poured money into the safety of US government debt. This high demand pushed the yield on the benchmark 10-year Treasury note below that key 4% level. For a lot of people in the market, seeing the yield drop below that number is a major signal that fear is in control.
All of this market chaos, of course, puts immense pressure on the world's central banks. So the crucial question now is, how are they going to respond? What are they going to do?
What's happening now is a clear divergence, a real split in how central banks are expected to react. In the US, traders are betting that the Fed will have to cut rates more aggressively to prevent a credit crunch. But the situation is totally different elsewhere. In the UK, you've got this persistent, sticky inflation, which means the Bank of England is still hesitant to ease up. And then in Japan, the central bank is still keeping the door open for potential rate hikes, despite all the global turmoil. It's a clear case of three major economies facing very different paths forward.
And this quote from the Bank of England's chief economist, Hugh Pill, really drives that point home. While the market is basically screaming for help, he's urging caution, worried that cutting rates too quickly could just reignite inflation. It's that classic central banker's dilemma.
So with all that's happened, where do we go from here? Let's take a look at the economic calendar to see what key data points could move the markets in the coming week.
All right, based on the economic calendar from investing.com, the big release to watch will be the Eurozone core CPI data. If that inflation number comes in hotter than expected, it's going to make the European Central Bank's job even harder. We'll also be keeping a really close eye on U.S. industrial production and capacity utilization for any signs that these credit fears are starting to bleed into the real economy.
And that brings us to our final provocative question. One really interesting observation from the day was that while regional banks were getting hammered, big tech stocks fueled by the whole AI narrative, they actually finished the day higher. They seemed almost immune to all the chaos. So the big question we're left with is this. As these serious credit concerns come back to the table, can this powerful AI theme continue to be the one part of the market that just defies gravity? It's something we'll be watching very, very closely. Thanks for watching. Don't forget to like and subscribe.